Okay, let's answer some questions from Sunday's Market Outlook. And I have not read any of these. It has been a fairly busy week here. Let's see. The first two are just comments. No questions here. Next one's a comment. Okay. In the event of a recession, do you think the price decrease resulting from widening spread on MBS will offset the price increase due to decreasing rates? Okay, I see what you're saying, that if we were going to get a recession, the spreads, your theory is the spreads would blow out while rates would drop. They're already fairly wide. I would have a hard time seeing why the market would want to push it past 300 basis points. No, I don't think so. Even if we assume a spread of 300 basis points, well, we're at 270 right now. We're near really record spreads on these. But 550, well, on the 10-year, 400 and where are we? 400 basis points, under 300 basis points now. I think there'd be more move downwards, 100 basis points downwards on a 10-year. I would have a hard time seeing 100 basis points widening from an already widened spread. No. Well, here's the thing. You tell me what causes the recession, then I'll be able to answer that. If it's anything commercial real estate or housing related, then, well, yeah, potentially. But if it's not, I don't see that, no. Just curious why you decided to go for MBS directly instead of like a company or ETF that deals with them. Well, a company has a whole income statement and balance sheet that gets in the way of you and the yield. Holding the security directly gives you a yield directly. Now, yield to what? Right? You don't know what your yield is going to be because if rates do drop, you run the risk of prepayments increasing. So the speed of the MBS would increase and you'd get your money back, principal and interest. Well, your interest, never mind that. You get that. You get your principal back precisely when you don't want to get it back. And if you're getting your principal back faster, then the principal that's remaining, that's earning the higher yield, becomes smaller and smaller. So there is the risk there, but you're not standing in the way. There's not a company and an income statement and decision standing in the way of you and the yield. When considering duration, what are your thoughts on using options on TLT to leverage positions? Well, you can, but if I buy strips, I'm getting that yield, that whatever that yield happens to be. For TLT, because interest rates are so high, let's just draw out a silly little price chart of TLT, and let's say it ends there, and we'll extend this out to 1 year, and let's say that you want to go out and buy. You were talking about using options on TLT. Well, you're not going to use 1 month options because a lot has to change in 1 month. So you may be going out to maybe September. Well, options are centered around the forward price. So it's not as if you can buy options at the same price at TLT and you'd get 50 delta options here. Your 50 delta options are around the forward price, and the price will reflect the delta. So you are paying for the carry in the price of the call, which means the TLT has to rise to the strike price first, and then you have to overcome the premium that you paid. And you could be right that TLT rises and you could still lose money depending on how far out you go and how much you paid. So being that interest rates are so high, long-dated calls end up being very expensive. If you're going to buy a long-dated call that is at today's money, but if you're going to buy a 50 delta call that is at tomorrow's money, tomorrow being the date of the expiration, it's still a 50 delta call. There's still a fairly high premium, which means the underlying stock has to rise. Well, what is a 9-month rate now? Just a little under 5%, 4 point something percent. It would have to rise by 4 point something percent just to hit your strike price, and then go up from there. Let's see. Those are the 3 questions. As a follow-up to my question about quantitative forecasting models and your response about search for ontological truth, one can study case studies about past events and attempt to find ontological truth about what the future might bring. This is sort of a premise of some research in social sciences is that if we have a data set of past events that we're interested in, we could look at the characteristic of those past events and things that happened from those past events and extract some generalities from that. And perhaps we have a probability that is not insignificant that those generalities may carry forward to other events like that. That is sort of a positivistic way of thinking about social science. A more relativistic way of thinking about it is you can really only say something about this group of people at this point in time, in this place in history, and that's it. That there is not much that carries forward. Not that there's nothing, but there's not much that carries forward because everything is embedded in a situational context. So it's hard to extract some effect out of a situational context and say, I have cause and effect, because it may be the characteristics of the situation that caused the effect. Hence, you have cause and effect in that situation, but you can't find it anywhere else. And this is very common in econometrics, where you will look at a relationship in one set of data in one country that you have a very difficult time replicating anywhere else. So a common one is the inflation-unemployment trade-off. This was found in UK data during, I think it was the 1950s, and it has been, the replication studies have been attempted, excuse me, in other time periods, in other countries, and have not found that relationship. What else do we have here? Another question. In the event of a recession, do you think the price decrease? Didn't we already have that one up here? Yeah. Somebody posted it twice. Let's see. As a retail investor, how should we think about exiting an investment and taking profit? If you have no model-derived target price, should you rely on analyst target prices or rely on rules? Take profit after 20%, or think of the underlying drivers for growth have changed. Do you follow any interesting non-finance related YouTube channels? Okay, so let's deal with that first question. You can follow the tone of the market. If the market is strong, it will carry stocks with it. You can look at the price reaction after earnings. If there's still upward momentum after earnings, there's something there. You can still look at the earnings. You can look at how the company is doing from quarter to quarter. When I say it's, I don't know that there's a lot of value in determining a target price. You can, from quarter to quarter, assess whether or not the fundamental story is still in place. And if it's still in place and the economy is still telling the same story, then stay in the stock. Now, some stocks I've stayed in for years without even bothering to look at things because I think they have great long-term perspective. The stocks that I would be getting into in 2024, Canadian apartment REITs, that's a multi-year story. So it's not a quarter-to-quarter story. I expect a bad quarter here and there. Because some quarters you're going to have costs that you can't control. Stuff happens, right? And same with copper. The copper miners, again, from quarter to quarter, I think they'll do okay, but every now and then they'll have a bad quarter. But copper, I think, is a multi-year play. So analog chips, I think, once we get much past late in 2024. I think that would probably be a good time. The best time for it is when you're coming out of a recession and demand starts picking up for consumer discretionary items. The next upswing in economic growth, global economic growth, is going to see a huge demand for analog chips. There's something I'm interested in, probably for multi-year periods. And if you have these long-term holding periods for those sorts of things, it would be your assessment of when you think the market has pretty much run its course, where you might want to think about reducing risk. Now, you don't have to fully exit a position. You could start selling, 30 delta calls on half your position, or selling, at the money calls. Let's say you have 1,000 shares, you could sell at the money calls on, 300 of them. So if it continues to go up, 300 would be called away. You'd still have 700. So it's not a matter, I don't know that I would look at it as exit the position as much as lower your delta. Lighten up a little bit, take a little profit off the table, sell 100 shares or whatever it is. Any interesting non-finance related YouTube channels. I've come to like the All In podcast. 2.5 of the characters on there I like. 2 I like. One sort of half. One I don't. I don't really. I think if the guy was my neighbor in real life, I would think I don't really like that guy. Yeah, I like 2.5 of them. Yeah. What else? Marcus Academy from Princeton. And then there's some universities that have different discussion series. I like those. Yeah, I don't really spend a lot of time out on YouTube outside of that, because to me that seems what YouTube is useful for. I have Prime, I have Apple TV, I have Crave. And when I was in Canada, you have CBC Gem, which, by the way, if you're in Canada, download the CBC Gem app. The amount of British shows you can get on there, off the charts. And some of those British comedies are really, really good. Brassic is really good. There's lots of other ways to entertain myself outside of finance other than YouTube. I'm sure there's lots of really cool stuff on YouTube, but I don't really explore too much. Let's see. How do you typically build out a position? Do you have any rules where you commit X percentage at the entry and follow that later? It depends on the target. It depends on what I'm doing. Canadian REITs, they don't really have very good options. 2 don't have options at all, so you pretty much just have to buy your position. It also depends on how long I think I'm holding for. If I got if I think there's a 3 to 6 month opportunity, then I care about my entry price. If it's for the very long term, then I'm not too concerned about it. I'll set up an allocation factory, which means I'll sell at the money puts 2 weeks at a time, every single week until I get my allocation. If I don't get my allocation, I've made all that money selling puts. I'll keep doing it. I'll keep doing it till I get my allocation. Also depends on urgency. Most of the positions I take really don't have an urgency to them. Because I'm not a day trader. So it's not like I got to hurry up and get in before the opportunity disappears. So usually I can build good positions by selling puts. And if it's put to me, great. I was going to buy it anyways, and now I just got paid to buy it. So great. And follow on at a later date. Yeah, that's pretty much how. If I don't have options, I'll buy opportunistically. I'll see something, I'll say, well, let's grab 500 shares here, even though that's nothing. It goes down a little bit more, grab another 5. Goes down a little more, grab another 5. And sort of just like that. There's not a lot of, I don't have a slide rule and a calculator that I get out and calculate an optimal number. It's just sort of, how I feel that day. I know you hear the creaking of the chair. I don't know why. It's a brand new chair. And it's creaking all of a sudden, but I have sent out for some WD-40, and this will disappear by the end of the day. The creak will. And then, I know you hear this room is hollow. I've been trying to find a room in this house that doesn't have background sound to it. I found one, but it's so big and empty, I gotta hang things on the walls and put things on the floors to, absorb the sound. Problems, I'm telling you. Where are we? Do you plan on having level 1 live Q&A sometime before February? Yeah, there's one planned on January 1st. You mentioned in the video Trudeau's insistent on more immigration, which will give him more votes. Do you suppose this holds true for U.S. Biden, given our immigration problems recently? I don't know. The research that I've seen for the U.S. For immigrants is that they tend not to be connected to the political system. That they don't engage with the political system like it's a very low rate. So I don't think it helps either party because the rate of engagement is very low. At least what I've seen out of California, there have been some studies looking at immigration and political engagement, and it is lower than the population. Now, when I say lower, statistically speaking, if you have large samples, you don't need to be much lower to be significant. And if we look at engagement by the population, we're not talking about a lot here. Okay, we're 37% is the typical engagement level in the population. 37%, and that immigrants tend to be lower than that. So I don't know about the U.S. Yeah, I just don't know. I have the applied series wondering what is the best set. Okay, well, that's been answered a few times. Seems to me that a lot more people are interested in investing in the stock market now than ever before. What happens when there's a big difference between the total capital looking to flow into the stock market and the total available investable opportunities? Shouldn't we get inherently richer valuations that would require higher average PEs than historically seen? And that's an interesting question. If you have limited investment capacity, but you have more and more dollars coming in, wouldn't that just drive up valuations? That if everybody wants a piece of this, wouldn't valuations drive higher? What has happened over the last 15 or 20 years is the proliferation of online platforms have brought investing to the masses. That individuals who never would have thought about it before now think about it. I think almost every 20-something-year-old has got some kind of brokerage account somewhere holding, 0.13 shares of Tesla and 0.00001 shares of Bitcoin and screaming about Tesla and Bitcoin all day long. I'm sure that there's a lot more participation now than ever before. However, what has also happened over that period of time is the alternative investment landscape has exploded. So that money that is in public markets, finding very efficient markets, has now drifted over to the alternative investment space looking for inefficient markets, because that's where you find alpha, is with market inefficiency. And if you can bring money into a place where there's market inefficiency, you're not too concerned about illiquidity, you have a long holding period, you can do better than publicly traded assets. So it could be that the amount of money coming in on the retail side because of accessibility is offsetting the money, the institutional money leaving into the alternative investment space. A lot of money that's coming into the market or that comes into the market also goes into things like crypto, which never existed before, so that does not crowd out stock investing. So I would say on net, probably not. I would say that the amount of wealth being created that needs a place to live is almost proportional to the amount of opportunities for investment that show up. Do you think it's too late to build out a position in XHB or wait for a potential pullback? If you're looking for a pullback, sell puts at where you think that you would buy. So let's say it's $85 and you'd say, well, if it pulled back to 80 I would buy, then sell $80 puts. At least make money while you're waiting. But no, I don't think it's too late to build a position, but I don't know that I would go 100% all in the position that you want. Slowly build out a position. Looking at inflation categories in the U.S., housing is the main thing keeping inflation up. We know that housing inflation lags behind many other categories, which would be worse for the economy in 2024. Strong disinflation leading to a potential period of deflation or a resurge in inflation. What would be worse? I'd say a resurgence of inflation because interest rates would go up. With disinflation leading to deflation, what would happen is the quantity of things purchased would increase. Buyers, most buyers in the U.S. Spend almost every penny they make. So if prices went down, they would just buy more stuff. It's not as if they would do the rational thing and hold back and say, prices are dropping, let's wait for them to drop more. They buy when prices go up, they buy when prices go sideways, they buy when prices go down, and they just buy whatever fills their cart. And they'll just use two carts. That's also, I would seem to think that a resurgence of inflation would be the problem, because interest rates would go up. When you have deflation, interest rates go down to zero, and the Fed then starts flooding the market with liquidity to try to inflate the economy. So I don't see that would be a negative. Okay. You mentioned Canadian apartment REITs having favorable outlook in the future. Mind going over some of the apartment REITs we have in Canada and who has the best outlook? I like CAPREIT, CAR.UN. I like that one. East Coast, KMP.UN. In Ontario, there are two. There's Minto and there's Interrent, IIR.UN. I've owned all of them at one point in time. I'm looking to re-own CAR. I bought it at just under $41, and I sold it above $50 on a Friday, and then it pulled back ever since. A bit under pressure until a Bank of Canada, sort of signals that it's all over. Now they have, but it's still a little under pressure. If I see it sub 45, I'll get back into it. Same with KMP. I see it sub 17, I'll get back into it. And this, because I'm not in Canada anymore, I can't just, I can buy it from outside of Canada. The withholding sucks, but in Canada, I do not have to get rid of my TFSA, and I do not have to get rid of my RSP or my LIRA, my locked-in retirement account. So I can still control those. I just can't contribute anymore to them, but I can still control them for wherever I am. Can we assume agency's price will pretty much follow what the spread is doing? Agency's price will do better with a contracting spread, lowering interest rates, and raising leverage. I think they'd be hesitant to raise leverage at interest rates where they are, repo rates where they are, but as rates start coming down, they should start increasing their leverage. So should all mortgage REITs, which would increase the demand for MBS, which should shrink the spread. So they will really start to take off once the rate cutting cycle begins. Last time we were in that range was 2021, agency traded about 15. But it's a complex product, so I'm not sure if we can count on returning 15 plus if the spread mean reverts. Seems like a wicked out of the money long call opportunity. If it does, yeah, I don't know that I would use the calls to get that done, because it does pay a nice income, so I would own it. If you were making this bet, how would you select the strike price for a 2024 agency long call? I would use a synthetic. I wouldn't just use a long call. I would use a synthetic because I would get the present value of the dividends in the put. How do you analyze durable goods orders with large month-over-month variations? I don't know that there's a lot of value in digging into it and thinking that you're going to find something there. If you're holding some equities, like CAT or DEER, it is worth looking at the capital goods, because we only hear from CAT and DEER once every 3 months, right? Within durable goods, there is a capital goods index. So you can look at the capital goods index. You'll get that every month. And CAT and DEER would be affected by that. That if we see that index really strong, we would expect that CAT and DEER should also have revenues. We won't say earnings, because all sorts of things can happen from the revenue to the net income on the income statement, but they should have revenues and maybe order backlogs that support that. So, and same with semiconductors, you can look at the category for that. Same with mining, there's a category for that as well. So I think it's more useful in conjunction with stocks that you may be holding which sell these durable goods. And this way here, it gives you some kind of monthly index as to the direction of where that category is going. Let's see. How would you trade the disconnect between the market, thinking that the Fed will cut rates before the BOC, and what actual data suggests? To me, it's clear that the market has it wrong, but not sure what an ideal trade would be without using futures. Ideally using options. I'm not that well versed in currency trades. Well, I don't know how I would get it done, because I don't know how the equity market is going to respond. But if you think that there aren't going to be 6 to 7 rate cuts next year, the easiest thing to do is to sell the Fed Funds futures for December 2024, which probably has 6 to 7 rate cuts already priced in. So if we're not going to get 6 to 7 rate cuts, that's a short for sure. So you could sell that one, but you are using futures. However, it's a small futures contract, which really doesn't require a lot of margin. It's the amount of margin required is very low. I still plan to make a video of top trades ideas for 2024. Yeah, it's already all the screens are already done. I just like to think it over. You know, am I missing something? Is there another idea that I have? Is there something interesting? You know, I don't want to put, here's my top 10 list. If you don't have 10, you seem to be struggling just to make a round number top 10, you know, just to have a top 10, my top 10 ideas and you know, just to get it in your title. I don't have 10 good ideas. I think I got about 5 or 6 that I would say these I think are winners. And then you can sort of get into more speculative stuff, saying, well, if we have this type of economy, then it's this. But if we have the, you know, that kind of thing. But the ideas I'll present are ones that I would say, you know, whatever economy we get, I would just continue to hold. Thoughts for the next 3 to 6 months? Oof. Main equity and fixed income sectors. Well, fixed income, I think I would want to be long fixed income for the next 3 to 6 months period. I would want to be long there. I have been long, and I'll continue to be long. Equities, you know, you're sitting below all-time highs, and I think even with today's market, you might be even squeezing up closer to those all-time highs with elevated interest rates. And we don't really have the kind of dynamics going on in the forward earnings that would suggest that the market needs to be bought. In fact, it suggests caution, if anything. You have a forward multiple over 20, and earnings forecasts coming down each week. Not a lot, but still it's the wrong direction. They're coming down. So I would say for the next 3 to 6 months, I'd be cautious on equities, but bullish on duration. Also wondering if you're more like Yardini, S&P 5400 or BCA 33. Well, that's exactly it. I mean, you have smart people in both camps, and you have some smart people saying we're going up, some smart people saying we're going down, and they come with gravitas, they come with good credentials. They're not idiots, you know, but that's how much interpretation there happens to be in the data right now, is you can make both cases. When you start seeing these ranges narrow and heading all together in a certain direction, and you can feel a little bit more confident. But I think with big variations like that, you know, where you have the bulls and the bears, yeah, caution. Let's see. Video on the measures being taken by Argentina's president. I don't really follow that, so I don't know enough to give an informed opinion, and I don't know enough about Argentina to have any kind of opinion that anybody really should listen to. It may be better for an economy to endure a recession and come out stronger rather than stay on life support through government stimulus. If the long-term outlook is deflation, wouldn't it be better for the government to keep interest rates elevated for the time being instead of announcing rate cuts today? If cutting rates can boost an economy, why not prepare for the day when the economy needs critical support? Well, everything works with a lag, right? I mean, We don't know if there's deflation until it actually shows up. I don't think that anybody on the FOMC is thinking about deflation. It is something that I think it's kind of obvious. Technology is permeating more and more avenues in products, in goods and services, and technology is deflationary. So, do the math. Like, I mean, if you project out long enough, you can just do the math, right? I purchased some TLT 110 calls September 30th, 2024. Currently, I'm seeing significant gains, but I don't want to sell as I believe the rally isn't over. Well, you have 110 gains. Where do you, or 110 calls, do you think you're going to 115? Do you think you're going to 120? What you can do to preserve some of your gains is sell the 120s. You own the 110 calls, sell the 120s. If the price drops, at least you make the amount on the 120s. Maybe you can sell the 120s for what you paid, making your position free, and that means you have no risk for a $10 spread. Well, I mean, you do have some risk, but no risk overall, no risk of loss with an easy $10 spread on the upside. So you can do that. You can start to sell some calls above where you paid to try to get a break even on your cost, but locking in a profit at this point pretty much means just exiting. You can, I think there's more upside to TLT to the end of September. I do, but you're also fighting time value, right? So you have a lot of gains right now, but if a month goes by and we don't move, you lose a month of time value. So premium comes out of those options every day. So you need the delta to move by enough to overcome the loss from theta, right? So there's a sort of a balance there. Looking to start my prep for CFA level 1. Don't have much basis knowledge of finance. If I buy your stuff, does it teach all from the? Well, yes, level 1 is basic. So yes, you don't need a finance background coming to level 1. It'll just take you longer to learn the language of finance: debits, credits, options, calls, derivatives, equities. It'll just take you longer to learn the specific language and what things are, but you don't need a background in finance for that. If the 30-year FRM finds ground around 5.5 and the 10-year around 3.5, how could this scenario affect mortgage REITs like agency? Well, first of all, you have a spread. Keep in mind, they try to immunize themselves from the interest rate, and they lever up the spread. So agency with leverage of 7.7, if the spread goes from 300 basis points to 200 basis points and they're leveraged on that spread 7.7 times, if I'll do the math, right? That's a big jump in asset value on the balance sheet. Now, as prices were dropping, they had fair value losses. As prices are increasing, they would have fair value gains. Prepayment doubles the current speed. I read through previous quarter 10Q, couldn't comprehend the prepayment risk to my satisfaction. Well, prepayment risk works like this. You owe me $500,000 at 6%. And every month you're going to give me some of my principal and some of my interest. And if you don't pay any faster, it'll take 30 years for me to get all my money back. Now, once we get into year 20 and year 25, the principal is going to be really, really small. I'll be holding a bond that doesn't have a lot of value, a lot of face value left, because on the last payment, there is no balloon payment, right? So I'm getting that nice yield. If interest rates start dropping, I run the risk of you going somewhere else to refinance your mortgage. And you're going to get a loan, you're going to get a new mortgage, and I'll be paid out of my existing mortgage right when interest rates are low. So I'll get all my money back to reinvest right when the reinvestment rates are at the lowest. For me, I'm okay with that risk of prepayment because I'm not going back into bonds. Now, if I had to go back into MBS, take my money and go back into MBS, then yes, I'm getting my money back right when yields are the lowest. I don't want that. I'm losing my high yield investment and I got to replace it with a low yield investment. But for me, if interest rates drop and I get my money back faster, great, because then I would want to be in the equity market at that time. So I would want my money back faster, thank you. So it works out. If you are not staying within the same asset class, then it's not necessarily prepayment risk, it's just fortuitous timing. But if you have to reinvest back into that asset class, if prepayment speeds increase, you got to reinvest at lower yields to maturity. To get the same yield to maturity, you got to increase your leverage. What do you think about the argument if Bank of Canada cut before the Fed, then inflation would rise back up again due to CAD devaluation, making it not an option? Most of our trade, our international trade is cross-border with the U.S. Most of it, if you remove the auto industry, like the stuff that goes back and forth just for the auto industry, out of Windsor back into Detroit, from Detroit to subassembly back into Windsor, the stuff that just goes back and forth is huge. It would still go back and forth. It would still go back and forth. Commodities, we sell a lot of commodities. We'd still continue to sell a lot of commodities because it's a world price, not a regional or local price. No, I don't know that I would look to CAD devaluation as the source of inflation. If Bank of Canada cuts and inflation starts to show up again, it will be domestically driven. I don't think it would relate to the CAD at all. Hypothetical scenario 1, we end up getting a hard landing. 2024 inflation drops to 2% or lower. I'd expect the Fed to cut rates aggressively, but also corporate earnings and unemployment to worsen. That's true. Which force will win out of SPY and TLT? SPY would take a hit. TLT would go up. TLT is not going to reflect the economy. TLT will reflect yields, and yields will reflect what the Fed is doing in response to the economy. But SPY will reflect the economy. That will matter more than yields for the earnings of SPY. Deteriorating macro data will hit SPY, and lower rates will boost TLT. We get a soft landing where inflation coasts down towards sub 3, but without hurting too much corporate earnings and unemployment, considering that the market seems to have already priced in the scenario to perfection, projecting 6 cuts in 2024, pushing markets to all-time high territory. What would happen to SPY and TLT? Well, it's hard to see how it goes higher unless we get more of what we already are expecting, right? So you got 6 rate cuts. If you only get 3, then the market's overvalued. If you get 7, then maybe you can say that we should have gone a little bit higher. The big thing is you have to see corporate earnings start to rise, not this slow bleed down every week. You got to see it start to rise in a significant way. We're just not seeing that yet. Let's see. What are your thoughts on EQIX as an alternative for DLR, considering DLR leverage? Yeah, DLR's got debt. DLR's got significant debt. I think that anybody, first of all, look at who their customers are. So if I've got, let's say Amazon, Microsoft, Google, and I have 50-year leases, I can lever the hell out of my business. I can lever up because I've got pretty safe cash flows. I can lever the hell up. But if I have a customer list that you've never heard of and they're all on 1 or 2 year leases or 5-year leases, then it's, well, now my cash flows are a lot riskier. Leverage is going to be less desirable. So yeah, DLR has debt, but you do have to look at the stability of its cash flows and the stability of its customers, right? If you've got a very good customer on a long-term lease that's not going anywhere, you can take risk. Much if you have a good job and a safe job, you don't mind getting a mortgage and a car loan. You'll lever up yourself, right? Same thing. Have a look at their customer list. Have a look at EQIX's customer list. Usually significant customers are disclosed. So if a customer makes up more than 10% of their revenues, it's typically disclosed. We have 4 customers that make up 47% of our revenue. And usually they'll talk about the length of the leases, the average length of the leases. They may even have the amount of capacity coming due over the next few years in terms of in terms of leases. Is there a reason why you think agency might be a better investment alternative than Annaly? No, no reason. No reason. DHI is at 149, an all-time high. No kidding, eh? Do you see it going further up in the near future, let's say 3 to 6 months? Well, if we stay on the path that we're on, sure, I can see more gains. One significant bank that has a research that publishes analyst research did raise price targets. I think DHI to like 170, 175. When are you planning on adding more videos to the portfolio construction series? Once we get into the new year, once you get like right now, there's nothing going on. It's kind of hard to show anything because there's nothing going on. I want something to go on so that I can show certain things. But if you get a market every day where it's like, well, there's nothing going on, it's like, well, how do I show something here? I mean, I can show. I've done a lot of the common strategies you can do. They're not strategies for every market. They're not strategies for every time period. But then there are some times where the market gives you a chance to do something. The market's not giving me a chance to do anything because it's just kind of boring right now. Is there any update on the CFA charter subscription? Yeah, so this is something that I don't release. This is something that Serify releases, and I think there's still some internal conversation there. And that's the last that I had on that. Stated technology is predominant deflationary force, and that you see deflation as the main trend for the rest of the decade. Other thinkers, such as Russell Napier, believe that exponential bipartisan fiscal deficits will force central banks' hand into fiscal dominance and financial repression, which is obviously inflationary. Which structural force do you think will win out throughout the decade? Technology or fiscal? Technology. Technology. Hands down, technology. Hands down. Period. Technology. Yeah. I'm trying to think of a good argument to support that one, but nothing much is coming to mind other than just my conviction that that technology is deflationary. If we're looking at investing in companies, companies don't really care about this kind of stuff. I mean, this can affect economies. I think I'd be more concerned about sovereign investments, sovereign bonds, perhaps. If you were in the Russell Napier camp, that would probably be something that you'd want to think about. But technology, you know, jump out 20 years, you can replace a hell of a lot of humans that exist today with technology. And it won't slow down. It will not slow down. It's not as if somebody's going to say, I think we've gone far enough. Let's stop here for a while. No, it'll keep going and it'll keep going. I recall some Canadian apartment REITs. Okay, I've already said which ones. Happy holidays, Feliz Navidad. Feliz is happy, Navidad is Christmas. Happy Christmas. Happy holidays to the Bears. Already talked about that. 3 questions. Technology is deflationary. I don't follow. If I'm running a business and the cost of technology input is going down, what incentives me to pass that cost savings on to the consumer when I could just use it to increase my margins? It's called competition. If you don't, your competition will. Period. Or somebody else will enter the space and they'll do it. It's not that you'll have a choice unless you're doing something where you have a clear monopoly. You'll have no choice. If Company X agrees to buy part of publicly traded Company Y in a stock purchase agreement, does the ownership of existing shareholders of the Company Y become diluted? No. Not unless new shares are being issued for that, which would be rare for that sort of deal. Can a large fund with 50 billion in AUM get exposure to small caps? Not easily. If it wants to add some small cap beta exposure. While trading individual small cap companies may not be practical due to its market impact, can buying a liquid small cap ETF? Well, yeah, you can do that. So you can buy RUT, which is the I think that's the ticker for the Russell 2000. You can buy that, or you can use futures. I think the Russell 2000 has futures as well. You can do that. You can use swaps. You can use an equity swap where you're going to swap the return on a small cap index for a floating rate. So there are ways to get it done, but to buy the actual stock itself, in most, they're small cap, meaning they're small, so they are investment constrained. I'm going to do 2024 outlook. Yes, I am. Why isn't the term index included in PCE prices? Because it's not an index. An index is a basket of goods that you can price out that same basket period over period. So the PC pricing in the quarter is for the C. Is what did C buy? So it changes every quarter, and because it changes every quarter, it can't be an index. So an index has known components. You know the components of the index. So this is not an index per se. It is a price series, but it's not an index. Let's see. Throat marks disparaging of Canada. Does he ever consider trade-offs with lower tax rates? Well, now hold on here. Let me take a little bit of umbrage with the way you've worded my disparaging of Canada. I have paid for the right to disparage Canada. I have lived there for 57 years, and if you sum up all the taxes I've paid, I believe I have earned the right to disparage Canada. I have the right to disparage them. I was under the impression that Canada had one of the lowest crime rates in the world. I don't know if that's true. But I will say I have very little run-ins with crime. It depends on where you live. When I lived in Brampton, I had my truck broken into, I don't know, half a dozen times, just to see if there was any loose coin or any ID that could be taken. But yeah, I've had my truck tossed a number of times. In Font Hill, not once. Not even if I leave it unlocked, nothing ever happens. In Brampton, I would never leave my door unlocked. In Font Hill, I leave the house. Sometimes I don't even think about locking the door, and then I get to my truck, I think, maybe I should lock the door, right? So I do. When I lived in Tecumseh in Windsor, I never locked my door. I'd leave and I just never locked the door. It never occurred to me to lock the door. So I can give it to you there that, depending on where you live in Canada, we do have fairly low crime rates. So while Canadians are taxed at a higher rate, the country is relatively healthy and safe. Whoa. You're bringing in a new word here, healthy. You started with crime, and now you're saying that Canada is healthy. You're talking about something different altogether there. So let's just strike that. We want to stay on the same thing. Is relatively safe. Well, I'm relatively safe here. There's lots of countries in the world that are relatively safe. I live in a gated community. You got to get past the gate. When you get to my house, I got another gate. You got to get past that gate. There are, I think, something like 40 some cameras around the property. You're not coming in here without being on half a dozen cameras. You're not getting past the front gate without being on at least 2 or 3 more cameras. I'm fairly safe here. And I've been out, and in the time that I've been here, I've been around. I've been out in different areas, in different places, and not once have I seen an issue. Not once have I witnessed anything. Not once have I even witnessed an argument, to be honest with you. So I'm not seeing any difference here than when I was in Windsor. I'm sorry, St. Catharines. But I'll tell you something, when I lived in Cleveland, by God, I would not leave my apartment at night. Gunfire every night. Now, mind you, I was in East Cleveland, which is not really the best part of town to live in. And I was white, so probably best to stay in your apartment at night. But I heard gunshots every night. Every single night. So I think it depends on where you live. When I lived in Florida, the place where I lived, I didn't hear gunshots once. Not once. So, right, depends on where you live. Look at areas with low tax rates. Crime is through the roof and infrastructure sucks. Whoa. Singapore, low tax rate. Dubai, low tax rate. No crime. no crime, and infrastructure is fantastic, absolutely fantastic. I'm here in Costa Rica. If you remove the drug crime, which is drug criminals shooting drug criminals, if you remove that, and that all happens pretty much on the Caribbean coast, if you remove that, Costa Rica is no worse than any other country in North America, really. You have petty crime in the tourist areas, but almost any Caribbean place that has tourists is going to have that kind of petty crime. Infrastructure's okay here. I have utilities. I have high-speed internet. I have, I think, 800 and some odd megabits, 300 megabit upload speed. I get everything here that I have at home. There are highways, there are roads. Now, mind you, there's no city planning. I'll tell you that much. There's no city planning at all. Good luck finding your way around. But so what? Big deal. That doesn't seem to be too much of an issue. Last time I visited Canada, the roads were well paved, streets were clean. Sure. Seems to me taxes are being put to good use. Well, you can't just look at roads and say taxes are being put to good use. You have to drive past one of those safe drug sites to get your free crack pipe. And I'm not kidding you, your free crack pipe so that you can do crack under supervision. Yes, I am not kidding you. I'm not making that shit up. Your crack pipe is given to you. The taxpayer provides your crack pipe so you can do illegal drugs. I want you to think that through. You want to do heroin, we'll give you the needles, we'll give you the site, we'll even keep a nurse on staff so you don't OD, so you can do your illegal drugs, so you can come back the next day and do more heroin. We don't want to see you die, do we now? So, come on now. Come on. How can I sell the June Fed futures? It's just a ticker. Just type in the ticker in your trading platform, if your trading platform allows for futures, and you just sell. Let's see. Are you in the recession camp? I got 1 foot in it. Yeah, I got 1 foot. I'm not ready to close the door on that one. Can you explain a bit more about what Goolsbee meant by needing to cut twice for full employment? Well, what he's saying is that if unemployment creeps up and he sees 4, 4.1, 4.2, he's saying that we may need to cut rates for the other part of our mandate, which is full employment. Because right now they've raised rates because of price stability, but they may need to cut rates not because inflation is coming down, but because employment is going up. So he's saying there may be a need to cut rates if that happens. And the last question here, I've answered twice. I think this is somebody that doesn't watch a Q&A video, so I replied. I've already answered this in the Q&A video. And that's it.